Well, I think I've been in the game for a while now, and I guess my first job in funds management was in 2007. So I wasn't managing money at the time, but I guess you could say I had a second row view of the GFC working in funds management. And I guess that was a defining moment, like most people, I guess, investing at that time. And it really taught you how volatile markets can be and how badly things can go wrong when, I guess, liquidity is sucked out of the system. But I found that even since then, since I've been managing money as a portfolio manager, there's been a whole bunch of crises that's gone on in the past you kind of look through and forget about because markets keep going up during that time. But effectively seeing things like the US sovereign debt crisis, even the US debt downgrade, seeing things like, for example, the taper tantrum in the US in 2013, even managing money in Asia when I was in Singapore during the Chinese devaluation of the currency and also the 2018 EM currency crisis. So lots of things going on behind the surface remind you how important it is to, I guess, stick to your process, stick to your fundamental beliefs, and not let market volatility really sway you away from those beliefs. So find as long as you have a set of beliefs that you believe in, so your philosophy stays robust and defined, and you have a process that can really sort of manage between different environments or throughout the cycle, really helps you sort of navigate through those volatile times. So rather than being swayed by market moves or the narrative of the time, that allows you to sort of trade ahead and be consistent in your approach. But it also helps you be nimble. Because if the market's jumping around you, because they say the market's sort of schizophrenic at sometimes, that gives you an opportunity to buy when there's opportunities or sell when there are opportunities. So if you're sailing steadily across or in a straight line of your views, and the market's volatile around you, you can actually be nimble and take advantage of those changes. I think the big thing that investors have sort of anchored to is their own history. So if you think about people who either worked during the GFC or in that post-GFC period, they're used to either two things. I mean, one, they can be uber bearish because they always expect the next recession to be a financial crisis, or B, they've only lived in an environment where you've had very low interest rates, very low volatility, and the only inflation you saw was asset prices. We think that's changing. And it might be hard to see now, but we believe we're going into a more normal environment where volatility, both in macroeconomic terms and in terms of the market, will be higher. So just having a set and forget 60-40 portfolio or just buying the index and equities might be challenging going forward. So we do believe that subtle shift of higher inflation, but potentially higher growth as well in the next 5 years, will give investors opportunities to be nimble and dynamic when managing their portfolios.